We'll go ahead and get started here. So welcome everyone. We're excited to have this webinar and bring some nationally known experts to talk about a study that we just released recently on the competitiveness of Oklahoma's tax code. So I want to get right to them, but I will introduce them so you know who they are. So Jared Walsack is the Vice President of State Projects with the Center for State Tax Policy at the Tax Foundation. He's the lead researcher on the Tax Foundation's annual State Business Tax Climate Index and a publication they put out called Location Matters. And he's authored or co-authored tax reform guides on Alaska, Iowa, Kansas, Louisiana, Nevada, New York, Pennsylvania, South Carolina, on and on and on, many others. And his work is regularly cited in the New York Times, the Wall Street Journal, the Washington Post, the Los Angeles Times, Politico, AP, and many other prominent national and state outlets. So Jared runs essentially the state projects portion of the Tax Foundation's work. His colleague, Janelle Kaminga, is policy analyst with the Tax Foundation's Center for State Tax Policy. Before joining the team, she worked with the Mackinac Center for Public Policy in Michigan, the Reason Foundation, the Illinois Policy Institute. So just briefly to set up our conversation today, I want to explain to everyone how we arrived at the point that we're doing this study. As you all know, there's always a lot of interest in tax policy in Oklahoma and at the legislature and among our members. And last year in particular, there were some reforms suggested that some of which got over the line and some didn't. And so through the end of the spring, we as an organization decided, really what has not been done in recent years in Oklahoma, we focused a lot on the headline tax rates that we have in the state. But really what we wanted to do was get a deep dive, comprehensive look at all the different ways that the state taxes and where that puts us in relation to the rest of the country. Because we began to notice that although we've done a lot of work in recent years on the rates, we still were not shooting to the top of a lot of national rankings. And so that began our quest to find someone who had the expertise and the credibility to conduct such a study. And so that's how we came into contact with the Tax Foundation. We partnered with them, and essentially our instructions were, we would like a deep dive look, a comprehensive look at Oklahoma's tax system. And the way the Tax Foundation works is they do that. And this is not something that we control the outcome or say, we can suggest things that we'd like them to look more particularly at, but really this is their independent analysis of Oklahoma's tax competitiveness. So that is our report or how it came about. And so to kind of take you through the highlights, I want to introduce Jared Walsack and Janelle Kaminga.
Well, thank you, Ben, and thank you for everyone on the call. I apologize for any noise behind me. We have a church next to us, and at noon, the carillon starts going, so you're hearing Old 100th as the background music, which I didn't intend. But nonetheless, it's great to be with all of you today to talk a little about this report that was introduced to you. I think it's important to mention from the outset that the Chamber, and we're very grateful for this, the Chamber commissioned us essentially to do this on an independent basis. This report is theirs in the sense that they provided important assistance in it, but it's ours in the sense that we're ultimately responsible for the content of it. The Chamber isn't necessarily endorsing every piece of it. And we also had independence in how we pursued this. It is a product that reflects what we think is the best options for the state of Oklahoma. So when we look at this, as was referenced in that introduction, our goal is to go a lot deeper than just rates. Obviously, Oklahoma has made some substantial rate reductions over the last, not just a couple of years, but over more than a decade. And those have been important. Those are valuable, but they don't necessarily solve some of the broader structural issues where there is room for Oklahoma to better compete. So I want to focus a lot on those today. This will be a very short, high-level approach. The publication itself is, I think, 50 or 60 pages and goes into much greater detail on all of these issues. But of course, Oklahoma has not grown as fast as many of its peer states. Texas has grown 75% faster than Oklahoma over the past 2 decades. A lot of other states have seen significant growth both on population and just broader economic measures than Oklahoma. And there are a lot of reasons for that. Tax is only one of them, but tax is one of the levers that is within the control of policymakers. It is something that policymakers can change to try to make the state more attractive. Obviously, there have been concerns for quite a while that severance tax collections will ultimately see secular decline. Right now, we're seeing generation of additional revenue and severance taxes compared to where we were a year or two ago, as the oil market has recovered quite nicely. But nonetheless, there is that ongoing concern that that is not a growth sector, and therefore there needs to be a diversification of the state's economy and a diversification ultimately of where the revenue comes from if Oklahoma is going to have not only economic success, but also stable tax revenues. And we undertake all of this with that backdrop. Within the corporate income tax, let's start there. Oklahoma, of course, has a very low rate, 4% going into effect. That ties with Missouri as the second lowest in the country. Missouri also just recently adopted that rate. That was a reform from a couple of years ago. That would be higher only than North Carolina at 2.5%. As of yesterday, North Carolina policymakers unveiled a budget, and that's a budget for this year. They're a little late. A budget that the governor is prepared to sign by the end of the week that will eventually phase out their corporate income tax entirely, which will, by the end of this decade, make them the third state to have neither a corporate income or a gross receipts tax. That contrasts, say, with like Texas, your neighbor, which has a gross receipts tax, even though they don't have a corporate income tax. So you have a very low rate, or will. But the issue then becomes, what are you taxing? What is the tax base? And there are a few things that are worth pointing out here. One, you are one of the states that has what's called a throwback rule. Functionally, with corporate income taxes, it's necessary to apportion income. We have multinational and certainly multi-state companies. They're operating in lots of different states. We need to determine what share of their revenue is really part of the taxable base in any particular state. And we do that by using a few proxies. Historically, it's been your share of sales in the state, your share of payroll in the state compared to payroll across the country, and your share of property in the state compared to property across the country. Many states, however, in recent decades have moved to only looking at sales into the state, what's called single sales factor, rather than that traditional 3-factor approach. You currently have what's called double weighted sales factor. That means 50% sales, 25% payroll, 25% property. What this means in practice is that tax burdens are higher on businesses that choose to locate people and property in the state. So you make an investment directly in Oklahoma, you pay more corporate income tax, whereas in many states, the only factor that matters is your commerce in the state. And companies generally are not avoiding a state market to avoid that tax. And therefore, the corporate income tax in Oklahoma is more of a tax on investment and capital accumulation than it is in many other states. So one of the things that we talk about in this report is shifting to single sales factor apportionment. This is becoming the default across the country. More and more states are adopting it. I think we'll eventually get to every state having single sales factor. There's not really a principled case that this is better than some other, but given that other states are doing it and given that it avoids this comparative penalization of investment in the state compared to other states, it makes sense to be looking at that now. But the other aspect of this is, as I mentioned, the throwback rule, where there are states that you have an Oklahoma company selling into another state, and they don't pay taxes there, not because the other state doesn't have a corporate income tax. That's not really the issue in play, but rather because they don't have nexus in that state, meaning the other state is not allowed to tax them. Their contacts in that state are insufficient. What this usually means is that they have sales into that state, but they have no payroll, they have no property in the state, they don't have sufficient other activity in the state, they're just selling products into the state. Think a lot of small and mid-sized manufacturers where perhaps their sales are handled by a large regional or national retail chain, or think of a manufacturer who's producing a part or a component that some other manufacturer in another state is using in their production process. They have sales in other states. They're not taxable often in those states. Oklahoma is one of those states that says, well, in that case, if you're not in the sales factor of the other state, we're going to put that activity in our own sales factor and we're going to tax you. And there's a pretty good literature on this saying ultimately it loses revenue for states. Not only are you driving activity out of the state and losing the ancillary taxes on it, but you're even losing the corporate income taxes on the directly related activity that would have been in your base otherwise, because this is such an impediment to a certain class of business that businesses either relocate or they work around it. They find ways to put their distribution center somewhere else, to ship from elsewhere, to have a portion of their business in another state to avoid this. Because let's imagine hypothetically that you had 10% of your sales in Oklahoma and maybe 50% of your sales in states where you don't have nexus. You are increasing your sales factor fivefold. It's 600% of what it would be otherwise. So this isn't just a minor increase in your tax burden. It is multiples of what you would pay if you were in any other state. It can lead to very high effective rates on the corporate tax for a small number of businesses. It's not most businesses. But what we see is that the businesses that are affected by this basically just don't operate in states like Oklahoma. So it makes a lot of sense to fix this so that you're not driving out a class of businesses or a class of industry and saying that Oklahoma is just not open to business for them. So we see an opportunity there. And then one thing that Oklahoma does very well is conform to the full expensing in the first year of select capital investment, consistent with what the federal government does. This is section 168K for those of you who are familiar with the Internal Revenue Code. It is that full and immediate expensing in the first year of certain investments. Traditionally, under like GAAP accounting, you would amortize these costs. You would depreciate property over time, and you only claim deductions for those business expenses over a period of many years. That's not, of course, how we handle other business expenses like payroll or a variety of other expenses. Those are deducted when they are experienced as costs. The federal government moved temporarily to full expensing under the Tax Cuts and Jobs Act. Previously, there was a 50% bonus. You got to do 50% in the first year. But now we are in a situation where that is going to expire, and the federal government will offer no accelerated depreciation on that bonus style whatsoever in a few years. And because Oklahoma conforms to federal treatment, Oklahoma will do the same, suddenly no longer offering any accelerated treatment of this expense. It would make sense for Oklahoma to implement this permanently without regard to what the federal government does. This is not a new cost. It's what you're doing now. It's just saying that even if the federal government's treatment of capital investment gets worse, that Oklahoma is going to continue to have a tax code that does not penalize capital investment. You do not want to overtax this sort of activity. Corporate income taxes are supposed to be on net income. They're supposed to be on your profits. So if we're taxing the amount that you have put into an investment or some portion of it, we're not capturing that properly. So we look at those as opportunities to improve the treatment under the corporate income tax. We also look at the individual income tax, where the new rate will be 4.75%. Of course, 9 states, including neighboring Texas, forego individual income taxes altogether. I already mentioned that Texas has grown significantly faster, 75% faster than Oklahoma in the last 2 decades economically. And overall, states without individual income taxes have seen their populations grow at twice the national rate. Oklahoma's population has grown 5.1% in the past 2 decades. That's less than 1/3 of the national growth rate of 16.3%. During that same time, Texas has burgeoned by almost 38%, twice the national, more than 7 times Oklahoma. That is a concern. Obviously, the goal is not necessarily to be exactly Texas, but you do not want to have that sort of gap with any of your neighbors. And if anything, right now, we are in an era of enhanced mobility. Individuals and businesses are more free than ever before to relocate for whatever reason they wish. It may be taxes, cost of living more generally, cost of doing business. It may just be where someone wants to live. But in an era where especially higher income white collar workers have much more flexibility to work remotely or to work flexibly, and where businesses know that they can locate somewhere even if their entire workforce doesn't follow them because they can hire across the country, you have much more opportunity for people to be sensitive to rates of taxation. And we're seeing this response already. 16 states, as of yesterday, have implemented or enacted individual or corporate income tax cuts in 2021. North Carolina being that number 16 yesterday. I guess technically Friday they will become 16, but we'll count that. We'll count that by the end of the week they will become 16. And there are more states lining up to do this in the next year. We've already seen, again, the largest wave of income tax reductions in a year that we've seen in decades. I think going back to the 1986 federal tax reform would be the last time you saw this many states make adjustments to their tax rates. And they're doing it because most of them are seeing economic growth right now. They're seeing revenues well higher than projections, but they're also concerned about what happens if they stand still because they understand we are in an increasingly competitive era. So we look at some options for tax reform. We suggest the opportunity of going to a single rate income tax with a much higher standard deduction. Doing so would provide that progressivity for lower and lower middle income filers, increasing the standard deduction from $6,350 to $10,350, a $4,000 increase, ensures that going to a revenue neutral flat rate would actually still be a progressive change for those at the bottom end of the scale, and then fairly close to flat everywhere else. The advantage of a flat tax, or one of the advantages of a flat tax, is that it's very hard to raise flat income taxes. You look at states that have single rate taxes, and it doesn't really matter which party's in power or what the what the political winds may be. There is much more resistance to raising a tax on everyone than simply continuing to ratchet up a rate that only applies to certain individuals. And given that small businesses are mainly pass-through businesses, they pay the individual income tax. There's a lot of job creation that is affected by income tax rates. Going to a flat tax, even if that is a largely revenue neutral move, is a really good investment in ensuring competitive taxes going forward. But we also look at some options to reduce income taxes even further to help close that gap with Texas and some of the other no or very low income tax states. We look at better design revenue triggers. Oklahoma has had experience with revenue triggers in the past. They were canceled, actually. They didn't fully implement because of a poor design. So we discuss ways that those can be designed to be effective to ensure that with adequate revenue growth, they will trigger future tax reductions, but also that they have safeguards to ensure that this is true revenue growth. It isn't flash in the pan. It's not recovering from a prior crisis. It's something meaningful. We also look, and my colleague Janelle Camago will discuss this in a moment, we discuss some pay-fors. There's been discussion for years about sales tax base broadening in Oklahoma as a way to pay down income tax rate reductions. And I think that that has probably been given a bad name in Oklahoma based on the way that it was approached previously, an approach that was pretty indiscriminate in what was placed into that base in ways that could have led to a lot of tax pyramiding. But there is a responsible way to go about that to pay down some rate reductions. We do see an opportunity to not only streamline the individual income tax, but also to reduce that rate. And with that, I'll turn it over to my colleague, Janelle.
Thanks, Jared. Yeah, so one thing that we're looking at in the sales tax is that it is in need of modernization in the base. So as with many states, Oklahoma's sales tax was created in the era of the Great Depression. And back then, goods were just under 60% of the economy. So it made sense that state lawmakers would focus on goods instead of services in the sales tax base, especially as services were a little harder to include. But today, goods are just a little over 35% of the sales tax base. And that means that that base is a lot smaller than it used to be. And as that base erodes because services aren't taxed, it gets a lot harder to bring in revenue without raising rates. The ideal sales tax base looks a lot different than this. It's levied on all final consumption, and including all final consumption will make that revenue a lot more stable, and it means that rates can be lower and still bring in the same amount of revenue. So final consumption, it means including services like I just mentioned, but it also means being really careful not to tax business inputs. If we tax goods and services that are part of the production process, then that can lead to an increase in costs because things are taxed all along that process. And that increase in cost is either passed on to the consumer or it can distort business decisions. Oklahoma has a lot of options for where it can expand its sales tax base, and I won't get into all of those, but some of the services it can think about are things like motor vehicle maintenance and repair, which are also a little easier to work with because there are already goods that are being taxed in those transactions, but the services aren't taxed. Other things to think about would be campgrounds and other recreational services, movie theater admissions, live entertainments, and a lot more that we go into in our study. Now, sales tax base broadening, as Jared mentioned, it's not meant as just an across-the-board revenue increase. It's meant to both make the sales tax base more stable and neutral, and it's also meant to pay down rate reductions or reforms elsewhere, whether that's reducing the income tax or any other kinds of reforms. Now, if base broadening happens at the state level, it necessarily means that it's also going to happen at the local level. And even if we make those rate reductions or pay downs on the state level, it doesn't mean that anything reduces on the local level. So it's really important that we make sure that local revenue stays stable. We want to avoid increasing burdens for localities. So that means that we would need to limit local sales tax collections in some way. So if the base is broadened across the board, then local limitations would look like a levy limit, a rate cap, or a change in local aid formulas. But whatever the technique, the state just really needs to take into account the effect that any base broadening is going to have on local tax burdens. Another issue that we mentioned is where services are sourced for sales tax purposes. Right now, Oklahoma charges sales taxes on tangible goods in the places where they're purchased, but it taxes services where the income producing activity occurs. It would be better if the state treated both goods and services the same sourcing wise and just taxed both in the place where they're actually purchased. Another thing that we look at is property taxes. In Oklahoma, those taxes are low overall, but they tend to fall most heavily on commercial entities. So because commercial entities are facing your ad valorem taxes, they're also facing the franchise tax and compliance-heavy tangible personal property taxes. So the franchise tax is a problem because it's based on a company's net worth and not its profit. So that means that companies are required to pay this tax regardless of their ability to actually pay it. So they could have a year where they post losses, but they're still required to pay that franchise tax. Now, Oklahoma does have a limitation, or it does cap the max amount that companies have to pay, and it does have a very low rate, so it does keep those costs down. But even for those companies that aren't paying a lot, it's still a nuisance tax because companies have to comply and they have to file every year and make sure that they are paying that tax. Repeal for the franchise tax is within reach, especially as that tax brings in very little revenue for the state. A lot of other states have already moved in this direction, and Oklahoma is only one of 16 states to have a franchise tax right now, so there are many examples that the state has to follow. Another issue in the property tax has to do with the base, and that's because tangible personal property, which is anything that can be touched or moved, is included in the property tax base. So that includes machinery, equipment, and other items that are a part of the business's production process. Now, this is a taxpayer active tax. It means that every business has to keep track of what its assets are worth, whether they're increasing, whether they're decreasing, and all things like that, which means that there's a lot of effort that goes into compliance with this tax. Another issue is just how much of the property tax base is made up of tangible personal property taxes. So in Oklahoma, those tangible personal property taxes make up 22.7% of the base, and that is really high, especially compared to other states. Now, because it's so high, it would be difficult to totally repeal this tangible personal property part of the tax, at least right away. But in the meantime, the state should definitely consider a de minimis exemption. Now that would exempt a certain amount of business machinery and equipment from taxation. Now, if that exemption is also made into a filing threshold, as would be best, then it would take these small businesses just completely off the tax rolls, and it would save them compliance costs because they wouldn't even have to file that tax, and the state would see minimal revenue loss. Even putting aside the broader tangible personal property tax, Oklahoma is one of 12 states to levy a property tax specifically on inventory. And this is especially damaging as it can favor certain industries over others, and it puts in-state businesses at a disadvantage. Large retail stores and other businesses that store large amounts of merchandise are going to be hit the hardest by this tax. Now, Oklahoma right now has a Freeport exemption, which provides for inventory that is temporarily held in the state for out-of-state sale, but this leaves out businesses that sell to those in Oklahoma or have longer-term inventory. So the state should build on its effort, and it should consider a full repeal of that inventory tax. And with that, I'll pass it back over to you, Jared.
Well, thanks, Janelle. I think that covers some of the key points that we wanted to raise in this. Obviously, there are a variety of different ways that Oklahoma can reform its tax code to better focus on economic competitiveness and growth, do so in a responsible manner. Right now, of course, many states, including Oklahoma, have pretty favorable revenue projections for the coming years. That makes this a good time to make reforms that might have transition costs, because there are some reforms that are revenue neutral over a longer run, but you may have a year or two of transition costs. So certainly, the availability of some one-time additional funding or surpluses or higher projections is helpful there. For broader reforms that have any costs associated with them, you want to make sure that there either is a pay for or there is a path of growth that allows that. But there's some transition effects that can be very much paid for at this moment. With that, I guess I'll turn it back over to Ben, and we would be happy to field any questions. But we do see a real opportunity for meaningful reform. The state, clearly policymakers have had a commitment for some time to creating a better tax code, and we hope this publication will help policymakers take those next steps.
Thank you all. So definitely want to answer any questions anyone has. So if you have questions, feel free to send them in the chat or just chime in, unmute yourself and ask it. But while we're kind of letting you think of your questions, I'm curious, Jared, what of all the things you looked at in the report, what's the most impactful, one or two that Oklahoma really should be focused on in the next coming years?
So there are a lot of things I think Oklahoma should look at, but I would love to see the state repeal the inventory tax. That would be one of the ones that first comes to mind for me. It is, as Janelle mentioned, something that relatively few states have. Only 12 states do, and of those, several have ways to substantially abate them. For instance, Louisiana and Oklahoma have credits that they don't work very well necessarily, but they are designed to eliminate a decent amount of the burden of that tax. So you are one of a relatively small number of states that is really hitting some class of businesses particularly hard, and also encouraging distribution and supply chains to move out of state faster than they would otherwise. Eliminating that, I think, makes good sense, and with that, maybe raising that, creating that de minimis exemption so that when you have a business with relatively little tangible property, they don't have to go through all of the compliance costs to write a check worth tens or hundreds of dollars.
It's interesting. We had some conversations yesterday about the de minimis exemption and how, in a lot of cases, the cost to the county to collect a very small amount of tangible personal property tax exceeds the amount of revenue the county actually gets from it. And so, but that if, certainly a lot of businesses fall into the category of they have very little property that is subject to tax. So they pay a very small amount, but under the de minimis exemption, they would fall entirely off the tax rolls. I'm curious also if you guys could dig a little deeper on revenue triggers and what went wrong before in Oklahoma with that, if it did, and then what we could make sure if we were to look at that approach going forward, how we could design that correctly.
Absolutely. When properly designed, revenue triggers are meant to help stabilize future reforms. That can be rate reductions, it can be other reforms that have a cost associated with them. So you are phasing them in based on actual revenue availability over a period of years. What Oklahoma did was use projected numbers. In fact, it went projection to projection. So there were never any actual revenues built into this. It was what your projection was for a previous year compared to your revised projections. And it was also year to year. So if, for instance, well, let's use recent years as an example. Let's say that you are projecting for fiscal year 2021 early in the pandemic, and you are really concerned about revenues, and you put out a really low projection. And then when it comes time to project for 2022, you've seen that actually 2021 was pretty good. And 22 is going to be even better. So you have a high projection for 22. You would show a really significant growth in revenue between your overly pessimistic 21 projection and now your maybe accurate projection for 22, even if they're actually quite similar, and you would trigger a tax cut even though the revenues were probably similar over the 2 years. Conversely, you could go the other direction. You could have been too optimistic and then too pessimistic. You want to use actual revenues for the previous year. You want to see what has actually transpired and get some proper levels. You also want to set a proper baseline. Going year to year brings in the very volatility that you want to avoid. What we want to say is the state is experiencing real, meaningful, sustained growth. So if you're going year to year and you experience an economic contraction and then you grow back maybe to where you were pre-contraction, that's not real growth. On the other hand, if you're seeing modest growth every year, that gradual accretion can be quite meaningful. So we want to set a proper baseline. We want to measure how much the state's revenues have grown, probably adjusting for inflation against that baseline over time, and then dedicate a portion, probably not all, but a portion of that real revenue growth to rate reductions. And we discussed some ways that you can do this in the publication. That way it's actually triggering something when it should, but you're not risking getting ahead of yourself and cutting at a time when that might not be affordable. This is supposed to solve the problem of when to phase this in, not create a problem for policymakers trying to decide whether they can do what the triggers say.
And so what are some other states that have had success with that, and maybe some cautionary tales?
Yeah, so North Carolina is a state that had significant success with these, twice phased in rate reductions and reforms using a set of triggers. The District of Columbia is a good example where the policymakers took a slightly different approach, but they took a whole package of different reforms that they had agreed upon, and they scheduled them essentially. They put them in order and said that using triggers over time, they used a proper baseline, they used inflation adjustment. When revenues are available, we're going to just keep checking off the list, going down the list until we are able to implement everything. Massachusetts used them for about a decade to continually chip away at their income tax rate. A lot of states have been very successful with this. Beyond Oklahoma, essentially not phasing in the second part of their the trigger. Another example, a negative example, would be Kansas. And their trigger is not what we usually think of when we talk about Kansas going off the rails on taxes. The trigger is not that. That was a very unbalanced tax cut where they cut taxes by about $1.1 billion and we're supposed to cut spending by a similar amount. But of course, Kansas budget isn't that large. No one really wanted to cut spending by $1 billion. So they just cut taxes by $1.1 billion and called it a day. And then we're kind of shocked somehow that they had a significant revenue loss. But they also had adopted triggers that would reduce revenues. And they used some projected elements, and they did year to year. So they were looking at implementing a tax cut in a year when really there wasn't the sort of revenues that would permit a tax cut. They chose to cancel it, which was the prudent thing to do, but they shouldn't have been there in the first place. A well-designed trigger would never have suggested a tax cut was appropriate at that time. doing this properly basically allows the legislature to set the parameters and the conditions under which a portion of future real sustained growth can be dedicated to tax reform and tax relief.
Great. I want to make sure we're making ourselves available for questions. So if anyone has a question, just send it in the chat or unmute yourself and get our attention. So Jared, you mentioned the inventory tax, but in terms of all the things you studied, what's the most economically damaging or holds us back in terms of economic growth in the state? Where, for example, does the franchise tax rate? I know it's a relatively small drop in the bucket in terms of revenue, but from an economic perspective, where do things like that rate?
It's way up there as well. It's like you said, it's a small source of revenue. For a lot of businesses, it's utterly irrelevant. It's just a nuisance. But for some businesses, this is a really significant burden because it is levied without regard to ability to pay. It is not on profits. It is on the value of a business. Not only is there a compliance and administrative cost associated with ascertaining the value of a business's assets or its worth, but also a business that is experiencing revenue losses. Maybe they've had a bad year, maybe we're in an economic contraction, maybe they're just new. They're a new company that has yet to turn a profit. They have to pay this tax. It is capped. That is a good thing, that there is a limit on how much you can pay under it. But nonetheless, a lot of businesses are paying when they don't necessarily have the proceeds, the profits, to justify imposing this tax on them. Most states don't have a franchise, or we often call them more generically capital stock tax. Most states don't have a capital stock tax at this point. Many states have moved to repeal them in recent years. Pennsylvania, Rhode Island, West Virginia, New York. New York had been phasing it out for a number of years. It was supposed to be fully phased out this year, and they panicked during the pandemic and reinstated it temporarily, but they'll get it done. Connecticut are all states that have phased them out in very recent years, and I think I may be forgetting others as well. Mississippi is in the process of phasing theirs out. It is definitely a tax in decline. States have realized it's not the way to go. As part of the reforms that are in the North Carolina budget that will go into effect, that is hopefully being signed at the end of this week, they will still have a franchise tax. Unfortunately, theirs is fairly significant, but they are reforming it substantially, reducing the liability for a lot of businesses. There's a recognition that this is a tax on capital. It's a tax on growing your business, and that's not how we want to design a tax.
So we've talked about Texas a little bit. Anytime we get into a conversation about comparing ourselves with Texas, of course, there's lots of wrinkles to that. Income tax always comes up, but then of course, we all know that property taxes are significantly higher in Texas than they are in Oklahoma. So I was wondering if you could just sort of put us in context vis-a-vis Texas, but also other states, maybe peer states, where generally, how are we doing and what can we expect how can we expect to compete going forward? What are we seeing from some of these states in their policy changes?
Not all taxes are created equal. Some taxes affect investment and location decisions and economic growth much more than others. Property and sales taxes tend to be much more pro-growth than income taxes because they're not penalizing labor, they're not penalizing investment in the same way. Real property in particular is not going anywhere. So taxing it, not only is there a pretty good justification for an ad valorem or a property tax in the sense that you're paying roughly in proportion to the benefits you're receiving from local government, but also it has much less of a distortionary effect on your investment decisions. And therefore, you're absolutely right that Texas generates a lot more revenue in property taxes than Oklahoma does, and that many other states do. But despite that, foregoing an individual income tax makes them more competitive. Part of this is just the sticker shock. I mean, people look at zero income tax states and that's very attractive to them. But a lot of it really is what you are choosing to tax makes a difference. Whatever you tax, you get less of. And the decision to tax investment in labor and future consumption makes a difference. We are continuing to see reductions in income taxation across the country. Corporate taxes are becoming a smaller and smaller portion of overall tax collections everywhere, partially because of policy changes, partially because of there being fewer C corporations as more and more businesses really are functioning as pass-through businesses. Partially due to incentives that most states have built extensively into their tax codes. And we look a little at the incentives in Oklahoma as well and see what's performing well, what may not be, and where there may be room for review. But with individual income taxes, we know that this is an important factor even for C corporations, because C corporations have employees too, and they have executives. They have people who are going to live there and care deeply about the burdens they face. So it is really important. It is a point of comparison. Texas has been able to position itself very well. Texas is a low tax burden state. That doesn't mean that it is the lowest tax burden state, but they have designed their taxes for the most part in a way that makes them very attractive and very competitive to growth and expansion. I think there's an opportunity for Oklahoma to follow in the footsteps in some ways. Doesn't mean you need to adopt Texas's model. We don't recommend that. If you look at our reforms, they don't make you look like Texas, but they make you very competitive with a state like Texas.
Yeah, we talked to someone yesterday, similar kind of conversation, and who pointed out that for someone like an Elon Musk, as they're looking where they're relocating, with that level of income, there's no amount of property tax that they're likely to pay anywhere that would equal what their income tax, and those are the decision makers in some of those companies. So on that note, so where should Oklahoma aim to get its income tax rate if getting to zero is too far too fast? Where should we be aiming?
Yeah, I think that's a great question, because I know there is a lot of talk about getting to zero, and it's a great goal. But one needs to be cognizant that pay-fors matter. That while it is that ultimately, in my mind, reducing or eliminating an individual income tax is an instrumental, not an ultimate goal, by which I mean that the goal is economic growth. And we know that reduced reliance on taxes on income is part of that. That can help. But there are pay-fors that could be worse. And you don't want to just throw the kitchen sink at the problem and say that anything available that allows us to reduce the income tax is worth it. You also don't want to be irresponsible and get ahead of revenues and create a crisis for yourself. So it's challenging to get immediately to zero, or to get to zero maybe ever. You don't want to rule that out, but you also want to look at where can we be to be more competitive. And Indiana has a 3.23% flat income tax rate. And we see them as one of the most competitive states across the board. They've done a lot of reform starting in 2011, reforming their property tax, reforming their sales tax, reforming their income tax. We point to Indiana, Utah, and North Carolina as some of the real guideposts for how you can have taxation across all the major categories, but do it in a very competitive way. So one of the things that we looked at in the report is, what if you shot for an income tax rate very similar to Indiana's? Again, not trying to replicate the entire Indiana tax code, but what if you get into the low threes for your income tax, while also making reforms to make the rest of your tax code more competitive? And I think that's very doable, not something you'll necessarily do overnight, but with the use of future economic growth, part of that being dedicated to rate reduction, maybe some broadening of other taxes, and some simplification measures, it's a realistic target.
We're coming up on our end time here. So I want to give one last chance for anyone who has any specific questions for our experts, and then give them a chance to close with any parting thoughts they have. I also want to put in a plug for the Research Foundation. This is exactly the type of work that we are engaged in and will continue to engage in the future, to have some of these deeper policy conversations that can really set up Oklahoma's economic competitiveness for the future, and not just for the economy that we've had in the past, but for what the future economy will look like. So Jared and Janelle, if we don't have any other questions, you got any closing thoughts for us?
Just that I think this is a golden opportunity. Right now, this enhanced mobility, the changes that have been accelerated because of the pandemic, it's both an opportunity, but also a bit of an obligation, because other states are acting and you can lose ground by standing still. States need to be responding to this new environment, but also there is right now the revenue. States have done better than anticipated, and that includes Oklahoma. You also have a lot of federal revenue that, while you can't use it directly for now to cut taxes, there's some litigation on that. And you shouldn't use it to pay down long-term reductions because it is time limited, even if it's not bound by federal restrictions. You have the buffer right now to handle some transition costs, to figure out what the revenue changes associated with different reforms would be, to phase in some really positive pro-growth reforms. This is a really good time to be getting ahead of these problems. And I think that there is a real commitment in the state. I hear it when I've been in the state. I heard it in the conversations we had while we put together this publication. Lawmakers, the policy community more generally, really does want to find ways to make Oklahoma more competitive, to position it for growth. There's this recognition that taxes are an important part of the puzzle. We hope that this book will be a contribution to those ongoing discussions. And I would just say that we always consider the publication of a publication like this a halfway point, maybe not literally in the amount of hours we're putting into something, but in the sense that we don't hand over a publication and say, okay, state chamber, thank you, here's a publication, go run with it. We want to continue to have conversations with all of you, with the policymakers in the state, to try to find solutions to use this as a starting point to see real meaningful reform in Oklahoma. We look forward to that conversation, and we really appreciate the opportunity to be part of it.
Well, we can't thank you all enough for your work on this. It really is top notch, and we look forward to continuing to work with you as Oklahoma improves the way it taxes. I would point everyone to, we've shared in the chat, I believe, the link to find the study. You can also just find it on our website or on the Tax Foundation's website, which I highly encourage you to visit also if you're curious about this topic. They have lots of useful interactive tools and charts and graphs that really help you put things in context and perspective. So with that, I think we will adjourn. Thank you for joining us, and never hesitate to contact us if you want to talk about this or any other policy issues. Thank you all.